Welcome back. You're watching Stockwatch with me, Simon Brown. Joining me to take the stock-related questions tonight, Graeme Korner from Korner Perspective and Rowan Williams from Nitrogen Fund Managers. Be sure to send your questions. Email stockwatch@bdtv.co.za, SMS 41392, or on X using hashtag StockWatch. Gents, appreciate the time this evening. I want to start, we've got US voting tomorrow. We'll have results out at some point. Rowan, let's start with you. Do you look at this election and do anything to your portfolio, or is it a case of if there are going to be economic impacts, they will happen and you'll make changes in time, or have you positioned ahead of the election?
Yeah, so I think this is an election that's a bit more fraught than in the past, and obviously the outcome is binary. But having said that, the differences and the impact on the South African markets, I think, are quite significant. You're either going to have a Trump presidency, which is quite protectionist, obviously anti-China, potentially excise duties and disruption to US trade relations, or you're going to have a Democrat presidency, which is very much, I think, business as usual. So, and it's so evenly poised, we can't decide. So in preparation, what we have done is cut risk, because what we're going to see is potentially quite a lot of volatility. Also, you say that the results will come out. I think it's going to take a little while longer because of those swing states. So in the interim, there's going to be a lot of sort of moving, and maybe, the Democrats or the Republicans are ahead. And so we could get some fairly big swings, and that might be an opportunity to put some positions on and put on some trades. But in the short term, we've just dialed back the risk in anticipation of increased volatility.
And Graeme, and I mean, court cases and I mean, who knows? They only swear the president in what, January, third week of Jan. Graeme, have you sort of tweaked portfolios ahead of this vote?
No. I think to Rowan's point, if you look at the US markets, the Nasdaq has really been the show driving the S&P. So the valuations there are a little lofty. You've seen some of the techs that have powered the market disappointing. So I would argue there was probably, if you did want to rebalance, there was an opportunity maybe to take a little off the table in some of those sort of high-flying US stocks before this. But I don't think the election itself is going to affect particularly the South African market. But I think, as Rowan indicated, it's going to be a noisy week.
Yeah.
I think generally it's kind of a pick your poison. Both candidates are quite keen to spend money, and that's not something I think that the country really needs right now. And I think that's really the core issue. But this is more around personalities. The GOP doesn't seem to be what the GOP used to be, and we know the Democrats like spending money and like introducing benefits. So I think the medium-term prospects are more important, and what after this 4-year tenure the deficit and the national debt will look like. That to me is probably more important than what happens in the next few days.
No, that's a fair point, and it is about that spending. Graeme, let's say with you, we had Redefine out earlier this morning on results. I mean, not a horror set. I suppose a tough period. Andrew Koenig does say in the statement that he feels that sort of the financial year 2024 to end August was the turning point, that the bottom is in. Would you subscribe to that? And I read certainly it's been a great year for the sector.
Yeah, so I think it's been a great year for the sector off a very low base. Yeah. So, there was a time when, everybody trusted listed property in South Africa. It was like you can go to the shopping mall, you can kick the wall, it's bricks and mortar, its value never goes down. It was almost like, upward revision rental mentality in the UK a few years ago. And suddenly that all came to a very abrupt end. So I think they've recovered off a low base. I'm still a little bit circumspect if you talk about the whole sector. I think there's still a lot of space around. I think things like e-commerce is shifting demand dynamics quite significantly. So I'm personally a little bit worried. I think landlords have enjoyed a better period maybe than the last 2 or 3 years. But I think those big challenges, including administered prices, remain. So Lower interest rates, good. Obviously, more normal environment is good, but I worry about how sustainably these guys can grow the distributions over the next 3, 4, 5 years myself.
Rowan, your take on the REIT sale and redefine? I mean, as an anecdotal, Rosebank Mall, Hyprop is my mall of choice, and man, there's a surprising number of empty shops there.
Yeah, I think I echo largely Graeme's points. The sort of the best days of sort of South African property from an investment perspective are behind it. We're getting used to much lower distribution growth than we had in the past, and obviously we've had this sort of yields inverting coming down, particularly I think in South Africa post GNU. We certainly seen the high yielding stocks, just appreciate quite nicely, but I think that short term run has played its course, and anecdotally, the economy is actually picking up a bit slower than people may have liked, and that remains headwinds. So I think there's still quite a few secular challenges, but they still have a place, but I think it's slowly declining over time. So maybe the pace of decline is going to be slower than what people were concerned about. So picking up off a low base, but I think in the short term they've largely priced in expectations for the next few years.
Yeah, I take your point on that. It has been, I think the index is up close to 50% over the last 12 months, which is a giant move. Ro, next day with you, question coming through around Supergroup, looking to buy into it. Stock been falling. Is there hope here? Quick zoom out of the chart. It certainly has been having a tough 3 years. It's at lows. It's off the pandemic lows, however. Rowan, what about Supergroup?
Yeah, it has been quite disappointing. They were sort of fairly steady growth. They obviously had quite a torrid time through COVID. Then their post-COVID results were quite promising. There was a lot of, they have exposure to sort of broad-based supply chain and car dealerships. There was that spike in car purchases. But that's all sort of turned around. So, and some of the acquisitions haven't been fantastic, particularly in Europe. They're struggling there, having to restructure. So if you look at it on a sum of the parts basis, given their significant interest in SG Fleet, it looks really cheap. The issue is, will they actually unbundle that or split the business up, because the rump looks like it's on a P of about 3. But that really shows you, the market's sentiments to the stock right now. Having said that, that may be an interesting entry point, and I think there will be increased pressure given the low valuation to look to unlock some value there. So you do have that optionality. So possibly interesting starting to add at this level.
Graeme, your take on Supergroup?
Yeah, I mean, if you just look at the chart over 5 years, it's looking really cheap. And I think what Rowan's saying is that there's value, but I suppose there's quite a few businesses where there's this inherent value and there's an opportunity to unlock it. The question is always whether management will have the appetite to do that. There are very few leadership teams, frankly, that are quite happy to see their revenue base and their empire shrink. So I think if they can do that, then I would agree with Rowan. So I think you've just got to take a call on whether you believe that value will be unlocked through the distribution. If so, then it really looks compelling. If not, I think there's some challenges facing the sector generally that will probably persist for a while.
Graeme, I want to stay with you. I want to come to Lewis' question coming through. Bought it in the pandemic because people are always buying furniture. Now up almost 4x of my money. Should I take profits? We had the trading update last week. I always call Lewis a bank that sells furniture. Say what you will. Man, they sell a lot of it and they bank it. And I mean, that trading update was really strong. 45 to 55% increase in HEPS. Good dividend. Good share buyback. Is there still value here at 74 odd rand?
Well, if you look at it on a multiple, I think what you're saying is right. That they've delivered and they've proven the naysayers and the doomsday prophets around that type of lending wrong. They've done it for some time, but I think. Let's go back to the question: do you bank it? So the question is, what do you want? You want 5x? You want 6x? If it was a trade, then I would argue you've made your money. But I think if you bought it because you thought it was a good story and you felt that they would continue to trade well, then you can run it. But I think if the question is framed around, do I take profit? Then I would say you've made your profit and there's probably something else. Maybe you follow Rowan and you say, sell this, go and buy Super Group. You could find that kind of value unlocked. So it's always about what you actually bought it for and what your longer term prospect is for the position and the company.
Yeah, no, I take the point. And when I'm buying, it's always, I write down why did I buy it, because it helps me inform when I would be looking and why and how I would be exiting. Rowan, Lewis, would you be a seller at this point? Rephrase that. Would you be a seller at great profit, or would you think there's still some upside here?
Yeah, I think you really have to look at an investment decision at each and every point. So there's been new information. You have seen that the results look incredible. I think, as you say, they're delivering. We had a presentation by an analyst this morning explaining how strong the lower end of the market is, the informal market is, which Lewis would sort of pick up those consumers. So I think there is potentially room to grow, and it still looks good value. So in the absence of finding somewhere better to deploy the cash, and it is on valuation metrics is still very fairly valued, I would tend to hold at these levels.
Okay, so you would be a holder there. What about ArcelorMittal, Rowan? He has a stock that, ArcelorMittal, obviously, once upon a time, Iscor, way back in the day. We seem to, as a world, have more steel than we need. And ArcelorMittal, I always can't help thinking, as a steel player, you've got to be a colossal, and maybe ArcelorMittal's just a little bit small. Opportunity in ArcelorMittal, because certainly it's been a stock that's had a rough time.
Yeah, so that's another sort of deeply discounted sort of NAV play again. It looks like a lot of value relative to the underlying assets, and certainly been very, very volatile and had good prospects and bad prospects. Very cyclical, the steel industry. What we did see is there was a potential buyer that feels they could run the steel mills a lot better and efficiently and really change the business model. So I think there is some latent value there, and people are seeing value in the underlying assets and the ability to unlock them. So, in the absence of that, does South Africa need steel mills? It's certainly questionable, and do we have a competitive advantage there? So I think without changing the business model, it's a tricky one. It's kind of a trading stock, and I would maybe look for points to get in and out and sort of make some money. But yeah, I think you have to watch it quite closely.
Graeme, ArcelorMittal, certainly the traders love it. Is there an investment case for ArcelorMittal? As Rowan said, I'm not sure that we need steel mills and that our steel mills are globally competitive necessarily.
Yeah, I think I was smiling when Rowan was saying, if they can change the business model, it's quite difficult to change the business model of steel mills. You're sourcing your steel locally, you're trying to produce with the various challenges that society throws at you in labor, for example. So, I can shrug my shoulders and say I have no idea. I think there are so many more compelling stories out there, even from a trading point of view. I'll just let it pass me by. You don't sort of always have to have an opinion, I think.
Nope, fair shout on that. But I'm going to ask you about banks. Question coming through. Rates are coming down. That should help the banks. Which of the big ones would be your preferred? Graeme, let's start with you in the banking space.
Sure, it's a slightly loaded question. I think if your bet is on the environment getting better, I'd say ABSA probably, because they've lagged, largely hurt by having to provide courtesy of non-performing loans. FirstRand has had the best business model for a number of years, but I think Standard Bank, if you just look at the African operations and contribution there, that's, I think, another reason to probably look at ABSA. So I think ABSA is looking the cheapest. I think the steady as she goes, the ship is got good momentum, is probably Standard Bank. So I would focus on those two, but ABSA looking very, very cheap. And if you're betting on a better environment and an improvement in earnings, I think ABSA is really looking compelling from a valuation point of view.
Rowan, your take on our banks, on the big banks?
Yeah, I think the interesting thing is, notwithstanding the strong run they've had, particularly this year, they've had actually very good earnings growth over the last few years post-COVID. And they're still looking quite cheap across the board on various metrics, dividend yield, earnings growth, price to book. So they still, I think, are quite good bets. I would agree with Graeme. ABSA has lagged quite significantly, so that's been somewhat disappointing year to date. But they also have an interest rate hedge in place, so they would be the most protected in a declining interest rate environment in terms of the narrowing of the endowment effect, where the banks had benefited quite significantly, Nedbank in particular. So their earnings could be a bit more defensive as we sort of move to lower interest rates and lower bad debts, hopefully, which would benefit them the most. So maybe the reasonably poised for earnings growth.
I want to stay with you, Rowan. Multichoice. I mean, not much happening here. There's a takeout offer, 125 on the table from Canal Plus, or Plus, as apparently I must say it, proper French accent. That's around April next year. The question is, why is it trading at 111? Should I buy it for the uplift? I mean, if you buy it now, what do we call it, 5 months? I suppose you're going to make yourself some 14 Rand in 5 months. Not the worst return. Risk is no deal.
Yeah, that's it. It's the investment case has largely, in the short term or the medium term, it depends on your time, is really the success of the Canal Plus transaction. So it's a little bit complicated because they need the approval of ICASA on the relaxation of the foreign ownership rules, or a solution for the foreign ownership rules. The buyer and Multichoice are quite confident that they will find a solution that will be to the satisfaction of ICASA and the regulators. But the risk is, if they cannot and the deal fails from a regulatory perspective, because Canal Plus went over 35% shareholding, they'd have to sell back down, and that would be quite messy. And given, just the evolution of the streaming business and the costs they're having to incur to get Showmax up to speed, you could see the share decline significantly. So it's sort of it's just got a volatility spread on it, either the 125 or the transaction doesn't succeed and it will drop substantially. So quite risky, and we're quite confident the deal will go ahead, but there's always a risk that it may not.
Hey, Graeme, is that not perhaps part of the, because these pop up from time to time value of money always looks attractive. There's always a risk of something failing. I'm thinking Marion Roberts, for example, many years ago, for what was it, an 18 or 20 plus Rand deal. You've got to want to own the underlying stock just in case.
Yeah, more than once, yours truly has bought something thinking the deal is a slam dunk, and then 25% later, you're sort of thinking, well, that wasn't really smart for a little bit of time value of money pickup. So I think I would argue probably half of the upside is almost time value of money. You can probably just get that by keeping the money in the bank.
Yeah.
Remember, you're also going to pay some taxes and brokerage and stuff to get into it. So I agree with Rowan. I mean, why would you get into this thing at these levels simply for a bit of time value? Because, let's go back a step. This company is worth a hell of a lot more to Canal Plus as a trade buyer than it is to you or I.
Yeah.
The reason, being that you look at the Netflixes and, the Amazon Primes, there's massive downward pressure, I think, on that model. So on fundamentals, I don't want to own it, and I would be very reluctant to take it, having been burnt by one or two corporate actions that should have happened that didn't happen. So, there are going to be other opportunities in the next couple of months, I'm sure, to make good, relatively low risk money.
Yeah, where you don't end up holding an old school satellite company in the process. Graeme, Safari Investment. A question came through. I've bought my first share. Safari Investment. Was it a good idea? It's not a stock I follow. They're a REIT. They've got malls and Actraville, Mamelodi, Sebokeng, Limpopo, Heidelberg. So sort of non-traditional Sandton, Rosebank, Century City. I don't know if you've got much insight into Safari Investments.
Well, there was quite a lot of hostility some time back, amongst the shareholders and so forth. So I haven't followed it closely. Just looking at the more recent earnings, it looks as though it's back on track. And you've seen others saying that, malls in in sort of the Mamelodis of the world are trading well relative to, Century City, for example. So I think that seems to be working well. It doesn't look expensive considering what they're generating, but it comes with risk, and it comes also with the backdrop of what I was saying earlier, that we're just not mad about the listed property space. So I'd probably just sit it out. In terms of if you've got it and you've made a little bit of money, then the question that you ask yourself again is, did I see this as a long-term investment? Yeah. Is this the best thing I think I can do with my money? And I think the answer will flow from there.
Rowan, any further insights into Safari? I don't know if it's a stock that you follow. It is a very small REIT on our market.
Yeah, so it is an interesting space, as Graeme was saying. If you look at Resilient and Vakili, they have some exposure sort of in the traditional sort of township malls, and they've been doing particularly well, trading much better than the formal sector. And we were having a look at the Boxer listing, and they've been growing in that sort of space, and they are expecting quite significant store rollouts over the next few years. So I think the underlying fundamentals are better than the balance of the REIT space. So it may be worth a close look at understanding where the malls are situated, the potential for growth. And I think it will be one of the better growth areas in the property space over the next few years.
Yeah, as you say, we've certainly seen Vakila, and of course, Boxers planning to roll out plenty. Rowan, staying with you, Sibanye Stillwater pops up, that in Sasol, but we won't do the Sasol today. We haven't had anyone else there. Sibanye Stillwater, we're seeing, I'm not brave enough to say there's a bottom in the PGM space, but both trading above 1100, platinum and palladium. Of course, Sibanye's got gold as well. They've got some mothballed mines in Montana. Sibanye Stillwater, is it time yet, or is it not yet?
So even though you were prepared to call the bottom of the PGM space, I think a lot of other traders, investors are. So I think they have seemed to have called it, if you've seen the price action over the last few weeks there. I guess if you want the highest beta play, it's going to be Sibanye Stillwater. A very a weak balance sheet, and they've got some assets they've had to curtail production. And so if prices do improve, they're likely to benefit the most from an equity value. But it does look like the PGM price basket increase has been more speculative than driven by underlying demand. Obviously there's ideas that supply of Russia will be curtailed, and sort of various toing and froing, but the car market space hasn't been good. Demand is sort of lackluster, and I think the PGM prices could come down again. I think it's certainly too speculative for our appetite.
Graeme, I'm not going to ask about you, Sibanye, because we need to get ourselves some stock picks. BHP Group.
Yeah, so we generally run very underweight resource positions through all the cycles. And the reason I'm going with BHP, it's just a machine. It's a giant. It's got incredibly good low-cost assets that, when you're producing iron ore at $18, you don't really care whether the price is $100 a ton or 120 or even 85. In fact, I think arguably tough conditions for mining companies with strong balance sheets and good cash generation and low-cost operations are almost like manna from heaven, because you could get, other guys being a little bit distressed. So, for me, BHP has got some capex that has been spent on long-term projects like the potash opportunity, for example, and some of the new copper assets that are going to hopefully be coming online. They've got, let's call it the right mix, I believe, of assets. The copper is going to do well, and I believe their capacity will be coming into the market. So, it's sexy, it's not exciting. It's not a Sibanye Stillwater, which is exactly why we're calling it. You're talking about $2.30's worth of earnings, and probably $1.30's worth of the US in dividends. You're getting a 4.5% dividend yield. You're getting a great quality commodity business that through the cycles, the earnings and the margins are very, very steady. So, I think if you're a commodity bull, but you're a coward like me in commodities, then, that's probably the one to back. And I think under $500, it looks good to me.
Under 500 looks good. Rowan Altron, results out this morning. Market liked them. The numbers look good. The share price looks good. And it's your stock pick today.
Yeah, so it certainly ticks a number of the quality boxes. I think we've got a new management team that have really invigorated the business. They've always had a good base of quality IT assets, Netstar, the various services business, and Werner Kapp and the leadership team really have transformed and are now realizing the potential of those businesses. We had seen the satellite tracking car businesses doing so well, but Netstar had sort of lagged, and now they're really growing the customer base, the annuity revenue stream, the return on capital, the EBITDA margin, and it looks like that journey has just commenced. And that's why I think we're still excited, notwithstanding a massive share price run-up. The P at sort of 12 times actually looks still quite reasonable based on the trajectory of earnings growth that we're seeing. So it's a quality business, quality assets, quality management, and should deliver quality earnings.
Yeah, and not too expensive at all. We'll leave there. That's it for tonight's Stock Watch. Thanks to our guests, Graeme Korner from Korner Perspective, going with BHP Group, Rowan Williams from Nitrogen Fund Managers, going with Altron. Up next, the close. Stay tuned.